Attention real estate investors. If you're not prepared for 2025, you could be leaving tens of thousands of dollars on the table. 3 major tax changes from the new One Big Beautiful Bill Act are set to completely reshape your investment strategy. Whether you're a seasoned pro or just starting out, you need to hear this. Let's break down exactly what's changing and how you can use it to your advantage. First up, the Qualified Business Income Deduction, or QBI, is now permanent. This is a game changer. This rule, also known as Section 199A, was scheduled to disappear in 2025, but now it's here to stay. If you own your rental properties in an LLC or operate them as a business, you get to deduct 20% of your net rental income right off the top. Let me give you a quick example. Imagine your rental portfolio brings in $50,000 in net income after all your expenses are paid. With the QBI deduction, the second huge change is the increase in the SALT deduction cap. SALT stands for state and local taxes. And for years, this has been a major pain point for investors in high-tax states like California, New York, and New Jersey. Finally, the third major update is that 100% bonus depreciation is back, and it's better than ever. This is a powerful tool for anyone planning to renovate or improve a property. In the past, if you spent, say, $50,000 on a major renovation, you had to spread that deduction out over many years, sometimes as long as 27 years. Under the new law, if you acquire and place the property into service after January 19, 2025, you can deduct the entire cost of those improvements in the very same year you make them. Think about what this means in practice. You buy a rental property and decide to put $80,000 into upgrades, a brand new kitchen, updated bathrooms, modern flooring, and a new HVAC system. Instead of slowly deducting that cost over decades, you can write off the full $80,000 immediately. This creates a massive paper loss that can offset your rental income, dramatically lowering your tax bill and freeing up capital right when you need it most, after a big renovation project. This benefit applies to personal property like appliances and furniture, as well as certain structural improvements with a useful life of 20 years or less. It doesn't apply to the land or the building shell itself, but almost everything inside can qualify. Pro investors are already using cost segregation studies to identify every single component that qualifies for this immediate write-off to maximize their savings. So, to recap, we have the permanent 20% QBI deduction, a boosted $40,000 SALT cap, and the return of 100% bonus depreciation. These 3 changes are fundamentally altering the math for real estate investing in 2025 and beyond. If you're planning to buy, hold, or renovate property, you need to factor these new rules into your strategy right now. But please remember, tax law is incredibly complex and everyone's financial situation is unique. These rules come with specific income limits, documentation requirements, and other fine print. It is absolutely essential to work with a qualified CPA or tax professional who specializes in real estate. They can help you navigate these changes, maximize your deductions, and ensure you're doing everything by the book to avoid any trouble with the IRS. If you found this breakdown helpful, do me a favor and hit that like button. Make sure to subscribe and turn on notifications so you don't miss our next video, where we'll be diving deeper into real estate strategies that work. Thanks for watching.